Good. Another one of the global players, this is Cerner. Now, this is a company that hasn't done well in recent months, so it'll be interesting to see what a different conversation it ends up. We're taking a bit of a change here. This is an IT solution provider, so its major customers are hospitals and surgical facilities and that kind of thing, and it's the IT system that links up with all of the billing and all of the electronic equipment that you get connected to. So for example, if someone's having a CAT scan, how it all kind of gets billed and registered, and when you arrive at the hospital they don't have to open another file and give you a damn clipboard and a pen, because they know already who you are and what your medical aid details and so on are. It's the world's largest in this space. Again, though, it does have competitors, headquartered in Kansas City in the United States of America, right in the middle there. Market capitalization, $18.97 billion. Price to earnings ratio, highish, 36.75, not a dividend payer. So here we're dealing more with like an IT type startup that gets big, market leader in its space. A lot of hype and hoopla around this one, but the PE came down because they stumbled a little bit with quarterly earnings that weren't so fabulous in recent times.
I mean, obviously it's a baby as look at it from a market cap perspective. We have Amgen at about 114. We just looked the other one at about
so this is
40
like
billion.
This is
certainly this is about half of Striker. So if you look in terms of PE, if you're a growth stock that's not paying dividends at 36, I mean, we've seen it with Naspers, where the PE ratios really just shoot up over the roof, purely because people are buying into the future. As a specialist, I guess, you know, they have to remain innovative. And as you say, if a doctor can look at me from Britain and still be able to perform his miracles, so certainly I think they've got room for growth. But I think, you know, in most cases, people after 5 years or so, people need to start looking at dividends. So if that's going to come through, possibly we'll start looking at it attractive.
Let's look at the chart. So that's what I was referring to. So it sort of peaks out there at about $80 a share, and since then it's sagged. So it had to do with the fact, look, in that 2014, 2015 period, there was a lot of good news. They won a big contract to digitize all of the patient record information for the entire US Department of Defense, as well as the servicemen that had retired already. Sort of fancy systems, device integration, employer-employee schemes, training systems, data mining. You can imagine the potential for data mining.
Yes.
You know, so hospitals can then look back at their electronic data and see what they're doing and where they had trouble and what sort of procedures people needed. Look, I like it a lot. One other little piece of information is that this is a company with a very dominant founder, a guy called Neil Patterson, who unfortunately himself has cancer. So that was another reason I think investors got a bit anxious.
Worried,
what is the future earnings going to look like? What's growth going to look like? And accordingly, you know, what is the management succession plan? So now on those ratings and with the share price, it looks like that.
Or their income is 80% derived from America. Certainly, if they start expanding globally, you know, going to China, into India, and the rest of the world.
They did buy a business from Siemens in Europe, which was in the same kind of space. So they do have this potential. But
that's what we're saying. So the potential basically those opportunities outside America might be able to give them obviously a sustainable growth path if they can look into that. I would be a little bit lukewarm on this one and stay out of it and
take a wait and see until there's a regeneration of some upward earnings momentum.
100%.
Okay, well, I'm full of this one, so I'm going to go with hot anyway, since I'm in, locked and loaded.